Hi, thanks for joining us today. My name is Tom Rosine. I'm the head of research services, and I'll be presenting the first quarter 2016 equity funds review. You know, it was absolutely a roller coaster ride of an event as far as the quarters go. We basically need to split this quarter into halves to get a better picture on what's going on. In this slide, I usually give kind of a brief outline: January, February, March. You know, the first quarter at a glance, so we get an idea where we came from, where we're going, how we're heading there. And no difference today for this presentation. We're going to take a look at kind of the breakout so we get just a better understanding. For the first half of the quarter, we had kind of the dour signs that we've been going through for quite so many months. Decline in oil, increase in the dollar strength against its competitors, and a very hawkish Fed. I mean, we had our first interest rate increase in December, which was actually, I think, a good thing. It was something that we needed to do. You know, obviously, we're trying to normalize interest rates. But again, I think it put people back on their heels, especially after hearing from some of the pundits out there that slowing global growth was still apparent. And in fact, some people were saying we were in a recession. Well, now we get to the second half of the story and the second half of the quarter, and we find out certainly we were not in a recession. Oil prices increased, the dollar declined against its trading partners, and we had a dovish Fed come out basically saying, hey, listen, we raised interest rates, but now we want to slow down and do it in an appropriate manner at appropriate time. And in fact, we're going to do two interest rate increases in 2016 rather than four. And so what this did is took people off the growth trajectory where they were buying growth and tech issues, and those fell out of favor, and instead investors turned their attention towards value and income-oriented type of securities. If we take a look at the January as a whole, there was three main things that popped out at us. You know, first of all, it's the worst opening ever we've seen to the first week of trading for the Dow and the S&P 500. So that was certainly set us off on a bad tone. Oil dropped below $30 a barrel during the month, and that certainly did not bode well for investors either. And then we saw the ISM numbers slip. And when we had this happen, you know, we expected when you have this type of downturn, the average mutual fund actually lost about 5.98%. But when we see this type of downturn, we expect at the bottom of this group, dedicated short bias funds up 9.03%. Certainly that is a trend we saw. And we also saw that health biotechnology stocks took it on the chin, down 14.47%. This is kind of twofold. First of all, people were running away from kind of the growth and tech-oriented issues. Those have been the darlings over the last several quarters, maybe even a year. However, they also had, you know, disappointing news over the last prior quarter and the like. And when people said that there's been a lot of pharmaceutical gouging going out there, so I think people said, hey, this might be time to let off the gas pedal a little bit. You know, take a little bit of profits that they had, hard-won profits, by the way, that they had taken, and so they let those basically slide. And then we saw China region funds down 12.72%. Well, that certainly makes sense. The first two trading days of 2016, their circuit breakers were triggered, and we had basically a stoppage in trading in those markets. And they found out that the triggers were actually causing more uproar, and people were actually exacerbating this issue by running to the market every time it opened to try to get rid of the stocks that they're holding. They got rid of those circuit breakers, and that was actually a plus as well. Well, that takes us to February, and February was really kind of a split month. I won't say it was a ho-hum month. It was weaker than expected non-farm payrolls. You know, oil went up and down, but it dropped below $31 a barrel again. And basically, we heard from the Saudis that said, hey, listen, we're not going to cut our production. And so that meant there was going to be this glut of oil out there, and it certainly played heavily on the decline in oil. However, during this concern, we actually had investors bid up gold to one of its highest runs, 10.52% in 1 month period of time. So it's been a while since we've seen that type of near gold price movement, 10.52%. And again, this was at the end of the month that we also saw durable goods orders rising about 4.9%. And certainly we heard that Q4 preliminary GDP growth was revised up as well. So that was a good thing. Seeing, the AU, which is the precious metal equity funds that we have, basically up 33.17% is not too much of a surprise when we saw such a rally. Those are basically the gold miners that have just gotten beat up over the last several quarters. And I think people saw this as a grand buying opportunity to buy some very inexpensive gold miners out there. We also saw commodities, precious metal funds up 7.08%. And of course, I don't think anybody's surprised to see that the commodities and energy funds down 8.59%, India region funds down about 8.51%, and Japanese funds down 4.52%. That brings us to March, which, by the way, it was the strongest 1-month return that we've seen for equity funds since October 2011. So really, the 6.99% return is certainly a grand return to have had for a 1-month period of time, and it certainly brought us back to a break-even point. So after a disastrous January, kind of ho-hum February, we got everything back in, maybe a little bit more for the quarter. And this is better than expected non-farm payroll news. Fed, again, announced that it would be decreasing the number of interest rate hikes that it would be having from 4 to 2 in 2016. And we saw that the ECB provided some stimulus, but it was lower than expected. And at first, there was kind of a little panic out there that it wasn't as broad-reaching. But then people thought, you know what? Actually, this might work out for everybody. It's not going to crush the banks as heavily as they had anticipated. You know, banks have really been taking it on the chin because of low interest rates, and that's a good portion of their income. So certainly that turned out to be a plus. And then here we saw probably the biggest movement, and that was the rally in oil, up 13.60% for the month. Now, we can't end this month without wondering why it didn't keep on going, and it's because we had a horrible bombing in Belgium. Many dead, many wounded, and certainly made people reflect back on what is really going on. They were concerned about the oil declining, again, below the $40 barrel mark. Durable goods orders fell for the third month in 4, and this actually was a boon for treasuries and also precious metal equity funds. They saw a late rally. Well, that brings us basically to what we're trying to talk about, and that's that quarterly representation that we had. Q1 2016, what happened? Second consecutive quarter of gain for equity funds, which is good. It may not have been much. You know, I told you right before we got to the slide, it was 0. It was just a basic break even, and it truly was 0.12% return is what we experienced for the average equity mutual fund out there. But really, we had some big winners. Sector equity funds, basically on an energy and material rally, saw a 2.28% return for the quarter. And I know that doesn't sound all that good, but remember, we were in some deep trouble, definitely in correction territory, down 10% and the like. So really being up 2.28% for this group is great. And obviously, we had world equity funds come in second with a positive 0.75%, and we saw USDE funds post negative returns 0.38%. And then actually the next best performing group out there was mixed asset funds, returning 0.75%. And I said that backwards. World equity funds basically came in at minus 0.2%. Now, 50% of all equity funds and mixed asset funds were in the black, and what that equated to is 54 of our 96 equity classifications here at Lipper were actually on the plus side. So there was a lot of negatives still. And we'll be able to see kind of how the breakout was. If you look at the leaders and laggards group here, we see gold, precious metals up 42.21%. Not a surprise since we saw such a big rally. Latin American funds, they were up 15.78%. And this makes sense because this was an energy and materials rally. So we saw not only precious metals do well, we also saw oil rallying, and we also saw basic materials rallying. And of course, anybody that was around basic materials and the like saw some upward performance, and certainly that was true with Latin America. And then with commodity precious metals were the next best performing, up 12.42. At the bottom, this growth area concept, getting rid of that health biotechnology, afraid of what the pharmaceutical gouging is going to be. Health biotech took it on the chin, down 13.88%. Global health biotechnology down 11.76%, and of course commodity energy. Remember, we did not have that big of a run for oil, just a slight increase. So for the quarter, still down 9.22%. But it brings us though to what the big impacts I think are for this quarter. And the big impacts are what the dollar did and basically what gold did. Dollar basically saw some weakness. We haven't seen weakness in the dollar for quite some time, and we saw it decline against the euro, saw it decline against the yen, strengthened a little bit against the pound. That might be because of the Brexit that's going on there. Basically, we have Great Britain talking about exiting the European Union, and there's just some concern out there as well, so the dollar strengthened against them. Commodity prices were up. Obviously, the big story, gold rocketed up 6.40%, and oil did rise, but only about 3.51% for the quarter. Well, that brings us now to our United States Diversified Equity Fund. And while investors had a watchful eye on global growth, they looked at the conflicts of central bank policies. You got one group cutting while you got another one talking about raising it, increasing interest rates, and also oil prices being all over. That made investors actually go towards I'll call it the kind of the bottom dwellers, and we shouldn't really look at it that way, but where they could buy some good deals and look at income. So two things that happened here: value-oriented mid caps who actually took it at the top, and then we saw equity income type of securities doing better. And this certainly might be a result from the less pressure from the Fed. Obviously with interest rates increasing, put a little pressure on income-paying, dividend-producing type of stocks, and I think that was a boom. So basically, we take a look at for the first quarter since Q1 2014, mid-cap value was at the top of the game, up 2.91%. Equity income funds, as I told you, did pretty well. Again, this is helped by the Fed decision, but overall, the United States diversified equity funds posted their worst showing, their worst ranking since Q4 2007. And when I say that, the four rankings are basically based on United States diversified equity funds, mixed asset funds, kind of the funds we just went through, world equity funds, and of course sector equity funds. And this is one of the first times in a long time we've seen USDE languish at the bottom. As we get to March, we see they had pretty doggone good returns at 6.50%, but they still only ranked 3 out of the 4 macro groups. But we saw that diversified leverage, of course, anytime you have equity leveraged funds, funds that are using leverage, and you have a good month, a good quarter, you see basically strong returns. There's where the 17% return is. But mid-cap value funds basically saw some very strong performance, up 8.71%. And again, for the month of March, where we looking at the Lipper active indices, we found that the strong performance was from financials. Now I'm going to tell you a little bit something later on about that, but financials actually were kind of the big mover for the month of March, followed by industrial energies in this particular group of mid-cap value equity funds. So certainly that was a story to talk about as well. Now we get to our basic, where I show you kind of all of the funds together, and we certainly know what happened. Value-oriented funds was basically the story up at the top, and then we have really what maybe most of the story is growth fell out of favor. Every single one, with the exception of dedicated short bias funds, at the bottom are growth. Small cap growth, multi-cap growth, large cap growth, mid-cap growth, all bringing up the rear. And certainly that was a continuation of that downfall in popularity and growth, and also in health biotechnology issues. So as we take a look now at the 4x3 matrices, the same story actually comes out and pops out at us. As we take a look at it, mid-cap funds for the first quarter in 4 were the top performers. So they outpaced, and in fact, the other ones had to mitigate losses, and they actually had a positive return of 0.27. And value-oriented funds for the first quarter in 7 basically outperformed the core and growth oriented brethren that they had. So certainly that was a story. And again, well, I told you, we had this industrial kind of utilities type of movement. Certainly financials were still at the bottom of the group for the quarter, because keep in mind that when we're taking a look at financials, we'll see this when we get in the sector equity groups, that people were still very concerned with the idea that oil was tanking, and there may be a lot of defaults on loans for banks that went to the oil and energy sectors. So this remained a concern until we got to the monthly type of returns that we were taking a look at. Let's take a look at the monthly 4x3 matrices and see how they stacked up. Basically, it turned out to be the same story. We saw that for the second month in a row, mid-cap funds posted the strongest returns of all the capitalization groups, and on the valuation groups, value-oriented funds for the third consecutive month, up 7.58%, showed a very strong preference for value. Of course, again, the whole groups did very good. Lowest performer in the group was large cap growth, losing about 6%, and the highest performing group was mid cap value, again, up 8.71%. And as we took a look at the Lipper active indices, the average mid cap value fund again benefited here from financials, and this is that kind of oil improvement concept, right? Where the Fed basically said, hey, we're not going to cut interest rates. Also, we saw that the accommodation by the Europeans was not as restricting, and so this was actually a positive thing for the month of March for financials. And of course, as I told you before, energy and industrials did very well. So just take a look at the sector equity funds, and it was obviously the top performer for the quarter. It's the best showing this group had in 7 quarters. So again, this is quite an amazing feat. And if we take a look at the top winners, basically we see 9 out of the top 10 performers in the entire equity universe showing up in the sector equity universe. However, if we look at the bottom, 4 of the worst performing are there as well. So this was kind of sandwiched between the best and the worst, and I guess it's been going on for quite some time. But if we look at the top leader here, the AU stands for precious metal equity funds, up 42.21%. That's their best quarter since Q1 1987. So it was quite a piece. And of course, at the bottom, as I told you before, drug pricing issues and kind of growth going out of favor. We see the health biotechnology funds down 13.88%, and global health biotechnology funds down 11.76%, and of course, commodity energies down 0.922%. So that brings us to the month of March, though, and again, second best performing group, up 6.93%, and this is where investors were kind of, still talking about buying on a dip, large declines in the dollar and the run up in the gold prices. So that kind of made a difference, for the end of the quarter. And what they were taking a look at in this case, though, was the huge run up in near month crude oil prices. They jumped 13.60% in March. And of course, why do we see that at the top then? Natural resources up 11.74, basic materials up 11.56, and global natural resources coming up at 10.06%. At the bottom, we kind of see the alternative managed future funds, commodity specialty funds. Those are basically either leveraged or short or both for commodities. And then we see the specialty miscellaneous funds at the bottom as well. The last one obviously still being in positive territory. So certainly something to write about with the sector equity group. When we take a look at this group, of course, at the top, precious metal, commodities, utility funds. Remember, I told you they moved towards safe haven plays, but they also moved towards income-oriented plays as well, and we think utilities got a boost there. At the bottom, here's the story I was telling you about. Financials are at the bottom, global financials, commodity energies, health biotechnology. These were all, funds that were, classifications that were being dragged down by, if you will, oil. In the first two cases I was talking about, global finance and commodity energy. Those three are basically kind of dependent on, I won't say on oil, but they were certainly being clouded as far as investors' views were, because they were afraid there was going to be more defaults in the commodity and energy businesses. And then we saw, again, the global health and health biotechnology. We've already talked about that as well. So growth and energy-related funds, again, we're at the bottom for the quarter. Let's take a look at our world equity classification. And basically, we kind of have that tale of two stories going on here. For the quarter, people were concerned about slowing growth, about lack of inflation, about the late March terrorist attacks. I mean, certainly that was a global issue, but certainly in Europe it hit home more. But as we got it going on into the quarter, that increase in oil, the decline in the dollar, and then also the ECB and the Bank of Japan easing, and then also China came out and cut its reserve requirements, certainly helped boost that particular part of the market. So for the Q1 period of time, Latin America funds were at the top. Again, we had this little rally that we saw in oil, and again, it wasn't huge at the time, but a little rally we saw in oil had enough to lift Latin America up. It was they went from rag to riches, from the fourth quarter's laggard to first quarter's leader, up 15.78%. Emerging markets also benefited as well, up 4.02%. And remember, I told you it was some income-oriented focus as well. So global equity income funds did well, up 2.38%. China region funds are still down, so there was still that concern. They were still trying to work against the big triggers that had caused the markets to close in the beginning of January. There were still huge returns that they had to try to gain back after having really gotten crushed, and then they started working on reserve requirements and the like, and so they actually ended up doing better on later on in March as well. It brings us to March. World Equity Funds, best performing macro classification in the universe. Basically, we take a look. Latin American funds up 16.55%. India region funds, kind of a story there, up 12.67%. And basically, whether you're looking at the BSE or the NSE, both of those are the kind of their primary indices there. They both posted their best monthly return in over 4 years. And this is on this change in global risk attitude. People saw the Fed kind of backing away. Looks like monetary easing was going to prop up some of Europe, maybe get some growth going. The Chinese, did this reflective piece where they decided to basically, change the reserve requirement, get some more money out in the economy. That just boded well, and of course, people, rallied about India region funds. Although I must say, in this exact same moment, there are a lot of questions that have been raised about Prime Minister Modi's reforms out there. So this is definitely not a slam dunk, and I would say buyer beware in this case. Well, let's go ahead and take a look at the 3x3 matrices that we have for the world equity funds. And we're only going to look at the quarterly returns for these. And basically, when we take a look at it, they're very in step, at least from a capitalization point of view, with what happened in the United States Diversified Equity Funds. In both groups, whether international or global, we see that the small mid-cap funds did best. That was certainly in line with the United States Diversified Equity model. However, on the international sides, it looks like international growth was able to mitigate losses better than value and core. Now, this did not turn out to be the truth in the Global Diversified Equity Fund group. They were up 0.90% in positive returns and really did mimic that stance, if you will, that United States Diversified Equity Funds took, where value was important and also small, and in that actually case it was mid-cap funds that did well. So those were kind of in lockstep for this quarter. As we take a look, again, this big thing that we're taking a look at, I like to show these so you can kind of see where all the classifications are. I use so many abbreviations in the other slides. Latin American funds at the top, emerging markets, global equity income, and of course at the bottom, China, Japanese, and India region funds. Any group with strong ties to natural resources and commodities showed improvement for the quarter. That takes us to our 2016 Q1 review of mixed asset funds. And they were up 0.75% for the quarter, second best performing group of the four macro classifications. And if you take a look at the top, this is going to support stuff that Jeff's going to talk about fixed income coming up. Basically, those funds that had a larger exposure to fixed income securities did better. So we see at the top of the group, mixed asset target today, mixed asset 2010, mixed asset target allocation conservative, mixed asset target 2015. All these have that same persistence, if you will, of having a very large portion in fixed income. Where you see some of the more aggressive areas, mixed asset target allocation growth funds in the negative, absolute return funds, convertible security funds at the bottom, and the last one, convertible security funds, actually gave back 1.79% of their return in Q1. One of the things I usually mention is the flows that went into these major macro groups, and I will say that the only group that was on plus side as far as year-to-date flows through February 29th, Pat's going to talk later on about flows through the entire quarter, but for the first 2 months, we saw mixed asset funds actually lose about $7.8 billion in outflows. That can be broken out. Basically, the target date funds actually saw inflows. The target allocation funds, target risk funds, if you will, those funds actually saw the outflows. But USDE funds lost about 16.3. Sector equity funds saw 4.3 outflow, and again, alternative funds saw 5.2. The only shining star in this group was world equity funds, taking in the first 2 months $22 billion. Certainly, that's a story to write about as well. Well, that brings me to my final piece, and this is basically when I talk about my concerns with where the market's going. I think there's still going to be a lot of volatility left because we don't know where the oil is going and the dollar is going. But if the dollar continues to decline, oil continues to strengthen, I think this is probably a good thing. But in reality, we have to look at China's slowing growth. It's still 5 to 6%, folks. We still have growth in that area. What actually concerns me here, though, is oil. Oil is still being below $40 a barrel. Yesterday's close was at $37.75, and we know that oil and equities, at least over the last several months, have been in lockstep. Oil goes up, equity goes up. Oil goes down, equity goes down. So we're going to keep a sharp eye on oil. Also, we saw central bank intervention. Are they out of ammo? How low can you go? We have seen Sweden and Japan and other European countries in negative interest rate mode. But again, that doesn't leave you a lot of room when you have a recession. So right now we're all right around zero interest rate. And that is a lot of concern for me. Also, after the Fed closed their last Fed meeting, basically we only had one dissenter that said, hey, listen, we shouldn't have interest rate, we shouldn't have stop our interest rate increases. Everybody else kind of supported that going from 4 to 2. However, since that meeting, we've had a couple of the key voting Fed chairmen come out and say, hey, listen, we may have to do this, pull the trigger and go for normalization sooner. What we need to hear is really, non-conflicting messages from the Fed. And I think once we hear the stories, we're okay with that. The interest rates do need to normalize, but we just can't have this on and off again type of attitude. Another big concern for me is the Brexit that we've been talking about. They're supposed to have a referendum in June to tell whether the United Kingdom is going to pull away from the European Union. That certainly could be a big issue. Earnings seasons also I have a concern of. The earnings per share pre-announcements, I got these from our Thomson Reuters proprietary research group in a new publication. Actually, it's an old publication with a new title. It's called S&P 500 Earnings Scorecard. You guys can get that free at our site as well. But if you go to that and take a look at it, the negative to positive earnings ratio, 103 negative for Q1 so far and 27 positive for Q1. This is a slight degradation from Q4 2015. Basically, we're coming in right around 3.0, and we were at about 3.8. So this is a little bit lower than, I'm sorry, I said that backwards. Right around 3.8 right now if you do the math on that. And basically we were at 3.0 for last quarter. If we look at the first quarter 2015 though, that negative to positive ratio was at 5.2, so we're much better than that. So again, it's just a concern that we've had so many negative pre-announcements, but this is one of the things that if we have a strengthening dollar, we may see in the second quarter, and this is down to my butts, by the way, if we see the dollar weaken, we may see the second quarter earnings come in that much better, because keep in mind, it'll open up more exports for us, and also when we repatriate money from foreign countries back to the United States, we will be using those foreign currencies to buy a weaker dollar, and that will actually hopefully show a greater profit margin as well. So that could be a positive. Back to the positives. This is really where I think we're going. I'm fairly sanguine on the market, to be honest with you. Non-farm payrolls increased 215,000 in March, beating analyst expectations. Both the ISM manufacturing and non-manufacturing indexes were well above 50, which shows expansion. If we look back to last quarter, we actually were in a contractionary period. For some of the numbers that you can see within the ISM numbers. Fed has dovish comments right now. They're saying, hey, listen, we're going to be slow and steady. We're going to be very methodical with what we're doing. And so this has been kind of the plan. And again, as I told you about the dollar weakening, we have seen the continuation of the weakening dollar. And there's no reason to think that that's going to stop anytime soon. I don't think we're going to have huge downfalls. But certainly, if we have continued monetary easing and we keep continuing on the steady path, and not talk about raising interest rates, I think we can still see a little more weakness that might work out for us. And if we take a look at the Thomson Reuters proprietary research team's announcement as well, that 19 companies have actually reported S&P 500 earnings reports so far for Q1. 58% of those 19 companies have reported so far have reported earnings that beat analyst expectations. Now, this is a little bit lower than the long-term average of 63%, but keep in mind, it's only the first 19 stocks out there that have actually reported. So, again, I think I'm a little more sanguine on this issue. Well, I'm going to cut myself off there. I'm going to hand off to Jeff Turnoy. Thanks for joining us today. And if you have any questions, we'll take those at the very end of the presentation. Thanks a lot.